Hello, we're going to show a simple example where the B2T engine makes a temporary adjustment automatically, and we will also show the engine calculates the tax effects of the adjustments automatically. To quickly review, the book balances in an input file into the engine follow an accounting standard, such as the US GAAP. In order to calculate taxes, these book balances needs to be adjusted to tax balances, which follow tax regulations. Some of these adjustments are temporary in that they will reverse in future years. The temporary adjustments essentially is to postpone the taxable income and tax deductions into future years. The engine will handle all that. The only thing that the user needs to do is to map his accounts into the standard accounts. So now let's take a look at the example. So here is the Hello World example where we want to calculate taxes for a US company P that has a revenue of $1,000. Let's assume that the company P has a rental property and it maintains an accrued rent account to record the rents that a customer has yet to pay, like this. So we have P, and it has a accrued rent, and let's suppose it starts with 150, and the ending balance is 350. So we also need to let the engine know what exactly is this account accrued rent. So let's go to the setup input. We need to tell the engine by adding an account mapping record here. So here it is. The accrued rent account is being mapped to this accrued income standard account type. So let's save it. And we're going to submit the thing into the B2T engine by using the easy button. If the engine happens to start cold, it may take 20-30 seconds to warm up. Otherwise, it'll be rather quick. So it's done. Let's open the output file. Now, let's look at the summary result. For the company P, $1,000 income, it has a total expense of $210. But we see the current expense is this 168, and the 42 is actually being deferred. Why is that? So let's go to the provision sheet to examine the calculation details. Let's go to that sheet by using the shortcut arrow here. So here it is. Now we need to focusing on the book to tax adjustment records. Here is our accrued rent account. We notice here's an adjustment value of minus 200 over here, which is credit 200 on the ending balance. We wonder why is that, and the engine tells us it is temporary adjustment. We need to go to further down into details. Here is the account level details for this calculation. We use a shortcut again and go over there. And we see the account level book to tax adjustment details. Okay, for this account, we have an adjustment value of minus 200, and it is temporary adjustment. Now, the calculation logic tells us, it has some brief descriptions, but the most important, it identifies the rules that's being used. And then next to it, here is the accounting treatment. It basically says if a goods and service is sold, then it was recognized as an asset. The cash may have not been paid. But the tax treatment is different. It says the accrued income is not really recognized. The income is not really recognized until the payment is received. Therefore, the tax basis for this asset account, accrued rent, is 0. So the book balance has changed from 150 to 350, but the tax basis remain at 0. So therefore, the adjustment is such that the book balances change has to be undone. So we need to have a minus 200 to undo the book basis change. So that's the reason why there is a credit 200 book to tax adjustments here. So what exactly are the tax effects of this adjustment? Now let's go back to the provision sheet. And the shortcut takes us back to the provision sheet where we see the important number, the adjustment value, and it's of type temporary. So we're going to go down and examine the current tax expense calculation. So it starts off with $1,000 pre-tax book income because we have a revenue of 1,000. Accrued rent is an asset account, so therefore the pre-tax book income is really just 1,000 here. And we'll look down this. There is this temporary adjusted item, accrued rent, 200. Now the adjustment is minus 200, which is the future taxable income. So in the current period, it is to deduct the book income, effectively push the 200 income into the future to be taxed. So therefore, the 200 adjustment here reduce the income to 800, and at 21%, we have the current tax expense of 168. So that's how we get this current tax expense. So we could further down examine how the deferred tax expense is being calculated. And again, we have our temporary differences over here. We have our adjustment minus 200 at 21%, and we have $42 deferred tax expense. And all the other effects is 0. So in the end, the deferred tax expense is $42. Now, we further look down how the adjustment impacts the rate, the effective tax rate. And here we look at the temporary items, and we found nothing. Now, intuitively, the temporary adjustment pushes the taxable income into the future. So the net effect is really does not change. The current plus the deferred taxable, it remains unchanged. So therefore, the effective tax rate in this case is really just the same as the statutory tax rate, 21%. Now this point is actually also being reflected in the account level detail. This push off effect is most succinctly reflected in the detail as the tax journal for the adjustment. Here's the tax journal. It basically says it has a debit deferred tax benefit of 42, but it has a credit current tax expense 42. These two simply cancels each other out. So therefore, the temporary item does not impact the effective tax rate. So to summarize, user only needs to focusing on mapping his account into the standard account like this. Then the B2T engine will automatically makes the book to tax adjustment for that account, and the engine will automatically calculate the tax effects of that adjustment. The users do not need to follow the ever-changing accounting standards or tax regulations. The engine has the relevant written rules and will automatically apply the ones that are enacted for the accounting period. That's it. Thanks for watching.